Right, what I want to talk about today is probably the most important part of Forex trading, and yet the most abused part of Forex trading and the most misunderstood part of Forex trading. I've been through several of these discussions before in previous videos, not part of the E75 course, but as part of some of the videos I've shared with the Traders Club and other folks in different formats and different arenas. But what I want to do is to go through this in some detail today once again, because as I have traded with traders all over the world, as I've observed them in the webinars that I've run, and as I've read the emails that have come in, I found that risk management is absolutely just what I said. It's the most abused and the least understood part of Forex trading, and a lot of traders get this wrong. And there's a lot of confusion around issues such as margin and leverage and risk and risk percentage of your account, how much risk is acceptable, and so on. I feel that risk management is the most important part of trading. And in fact, without risk management, without the correct understanding of it, you'll find that no matter what kind of trading system you use, you're likely to fail at Forex trading. Conversely, if you have good risk management, you're likely to succeed at Forex trading no matter how good or bad your Forex trading system is. Now that's a very important point, and I just want to try and put that up for you right now. So trading system, and I hope you can read this, is equal to no guarantee. And I'm sure I've spelled that wrong, but spelled it wrong. Those are meant to be the other way around. Having a good system is no guarantee of trading success. Whereas on the other hand, risk management or risk control, let me just write it like that to be quicker, risk control is equal to success. And that doesn't really matter what your trading system is. So you could have really any old trading system, and it doesn't matter what your trading system is. So risk control means you should succeed at trading no matter how good or bad your system is. But a good trading system without risk control is probably, and I've said no guarantee, and that's G-U-I-A-R, is no guarantee of success. And in fact, I should say a good system without risk management and risk control is not equal to any success. So you will not survive, you will not succeed at Forex trading unless you have good risk control. So I want to be very clear about that. It's not normally your trading system which defines how well you do or don't do, but it's how well you manage the risk of your trading and your account. Now, if you remember in week 8 videos in previous week, and you can go back and have a look at this, just remember week 8, we talked about no-brainer trades. And I'm going to go through what I think are the 4 key elements of risk control, and I'll discuss them in detail. And let's have a look at them. The first one, and I've just put it there, is to take no-brainer trades. The second one is to understand risk, reward, and apply that every time. The third one is to understand leverage. All right, leverage. And the fourth one, I actually can't remember. Isn't that odd? But I think it was percentage risk, or risk percentage. Those are the 4 elements of successful trading looked at from the point of risk control or risk aversion. Now, let me just say the most important thing in trading is to minimize risk. All right, so the most important thing is to minimize risk. And if you can do that in your trading, and I'm going to try and get rid of the screen draw quickly. Okay, so minimize risk. And if you can do that in your trading, then you should succeed. Now, I just want you to pause this video and roll back a little bit to the 4 elements of risk control. And just make a note of that. In fact, when you watch these videos, you should be making notes most of the time. And if you've missed out on taking notes, in fact, what I would suggest is that you get a black counter book. That's what I use, a black A4 size book with plenty of pages in it, and make notes as you go through all these videos. Now, you might fill up a couple of books because there have been a lot of videos, but I want you to write down those 4 things: no-brainer trades, understanding leverage and margin and all that sort of thing, risk-reward, the risk-reward ratio of your trades, and finally the risk percentage that you take per trade. And all of these aspects are aimed at, or the purpose of all of them is to minimize risk. Now, the first one, as I said, is the no-brainer trades. Now, I want you to go back to last week's videos, or perhaps it's week 7, and go and have a look at the concept of no-brainer trades. Now remember, I'm going to repeat myself a little bit quickly here. Remember, that means a dramatic reversal or a tiny stop loss. Now, remember that the more dramatic the reversal is, the less likely it is that that signal will be false. So when we look at a dramatic reversal, we're looking for candles that are bigger than anything else. Okay, so we're looking for candles that are massive, candles that are huge, candles that are at let's say 1.5 times the size of all the surrounding candles or the previous candles. We're looking for something like a big spike high, a big spike low, something like this. Oops, I think I've gone off the screen. So a big spike high, a massive spike low, or let's say a big bearish candle like this, followed by a massive bullish engulfing candle, with all the other candles sort of much smaller, around that. So we're looking for these dramatic reversal candles, and when that's seen on your charts, that's a no-brainer, because the risk of that being a false signal is small. So although the candles are big, the risk of it being a false signal is small. And so by picking this type of dramatic reversal, this kind of no-brainer, we're actually reducing risk by eliminating some of the iffy trades. The second way to do this with a no-brainer reversal, and remember, this is all regarded and related to the TNT trading system, but this also applies very much to E75 as well, particularly when we're talking about the tiny stop loss. Now, when I say a tiny stop loss, I'm talking between, let's say, 10 to 15 pips. Let's say at least less than 20 pips. Okay, that's a tiny stop loss. And the reason I like to go for a trade like that is because, first of all, I can risk, let's say, 1 to 1.5, and we'll come to this now a bit later, 1 to 1.5% of my account only, and also my risk reward ratio goes dramatically in my favor. Excuse me. Now I'm going to be talking about risk and risk reward a little bit later. But I just want you to remember that the dramatic reversal and or the tiny stop loss are the 2 things that we're looking for in no-brainer trades. A no-brainer trade is a trade which has lower risk than any other trade, either because we've got a dramatic reversal, which means that the chance of it being a false signal is smaller, or because we've got a tiny stop loss, and even if it's not a high probability trade, excuse me, if it's not as high a probability trade as a dramatic reversal, the fact that we've got a tiny stop loss means that the risk is reduced automatically. I want to say one thing about dramatic reversals, and you remember I said a dramatic reversal involves very large candles, and because we've got to put our stop loss on the other side of the reversal, that often means the stop loss needs to be pretty big. Now, there are 2 ways to counteract this, and perhaps I can go straight to the charts, and I'm going to pause this video and see if we can get that up on the... Alright, so here I've got an example of what I would call a dramatic reversal. We've got these beautiful spike candles, this one particularly here, and then we've got this very bullish candle which reached almost up to the top of that candle, and then we've got actually, hang on, I'm going to have to move this chart down because it's just off the screen. All right, so we've got this candle here, which is a reversal candle. Beautiful big reversal candle. And then a little bit later on, we've got this bullish candle right here, which reached almost to the height of that initial reversal candle. Then we've got this candle here, which is a dark cloud cover, and once again you can go back to the previous videos to have a look at that. Then we've got a nice big retracement on this candle here, back up to near the top of that dark cloud cover, and then we get the move down. Now, the objective of trading the dramatic reversal, and I'm just going to put DR right there, the objective of it is either to get into the trade with a very small, now you'll see a lot of this takes place in the webinars when I'm trading live with the guys, but it's either to get in with a very small position size, or low leverage, and I want you to refer later on into the later part of this video to understand. Okay, that's terrible. All right, you know what I mean. That's a word. That means low leverage. Small position at low leverage, or wait for a retracement. Now remember, I'm talking about dramatic reversals where the stop loss needs to be quite high, or wait for a retracement. Now, let's have a look at this one in more detail. And let's have a look at the first trade here. Now, the stop loss on that first trade, let's just get it on the screen, would have, the high of this candle is 37.22, and the entry price would have been at 36.80 odd. So that would be a 40 pip stop loss on this trade, and on this trade here, and the same more or less if we wanted to short this, in other words, and the same more or less after this engulfing candle, or this dark cloud cover, and we wanted to short it, the stop loss would have to be circa 40 pips, circa meaning more or less 40 pips, just a liney way to say it. So we want to reduce that stop loss to as little as possible. In fact, I like to take most trades with about a 2% risk. Once again, we'll come to that a little bit later in the video. I would like to then take the trade at 2% risk. One way to do that is to reduce the position, make a smaller position, and if I cut my position size in half, I can get within with a 2% risk. Or if I wait for a retracement until the entry price where I get in is 20 pips below where the stop loss needs to be, again I can get in with a 2% risk. Now, a lot of this is a little bit complicated for people to understand if they're new to trading, or if they don't understand risk particularly well, or whatever. There's a variety of reasons, or perhaps you're not that good at mathematics. It doesn't really matter. There are some reasons why people don't understand this too clearly. So I'm going to try and explain percentage risk and leverage a little bit later on in this video, but I would encourage you, I really would encourage you to either attend the webinars or to watch the webinar videos if you can't attend the webinars. The reason for that is because we often discuss position size, risk, leverage, etc., etc., during the live trading scenario. So you can see this actually applied during live trades. So you can either watch the videos or attend the webinars, and you'll pick up a lot of this, and eventually it'll become intuitive to you. It'll become second nature. You'll be able to quickly look at the situation and sum it up and be able to take the trade with confidence, knowing that your risk on the trade is relatively small. And yeah, that's really all I want to say about that. So I'm now busy covering the no-brainer situation, and I'm now going to go back to the blank screen, if possible, and it is possible. So the first mechanism to reduce risk is to go for these so-called no-brainer trades. And again, you'll see a lot of this on the live webinars, which I talk about no-brainer trades, and you'll also see a lot of this in some of the previous videos, week 7 and week 8. So that's the first one. Now I want to emphasize, I really want to emphasize that risk and money management is the single most important aspect of your trading, and you need to get to grips with this. If you don't understand it, ask questions in the webinars. Email me and say, look, man, I need another video on this particular thing or that particular thing, and I'll try and squeeze a new video in. But really, if you don't get to grips with this, you will not succeed at your trading. You will not succeed at your trading. And a lot of money management and risk also boils down to discipline. Now, what we're talking about here, these 4 aspects of money management, need to go hand in hand with discipline. And if you cannot be disciplined to adhere to these simple concepts which I'm pointing out, if you can't adhere to the discipline of sticking to these things, then again, you will not succeed at trading. Now let's have a look at the second one, and I simply can't remember in which order I wrote these down earlier, but I think I talked about leverage. Leverage. Now again, a lot of people don't understand leverage, so I'm going to go into this in some detail. There are different ways that brokers explain this, or different ways people understand this. First of all, there's leverage. That's the word I use, which is the simplest and the most meaningful word, really. Then brokers will talk about margin, and I'll cover that. They'll talk about how much you risk, how much of your account you use, sorry. So let's say you use 2% or 3% of your account. They'll talk about that. They'll talk about you being able to use a 200-to-1 margin or 100-to-1 margin. And all of these different concepts, people struggle to understand what the difference between them is, what the importance of understanding them is, how they relate to each other, and so on and so on. So what I'm going to say to you is ignore this, ignore this, ignore this, and ignore that. And whilst all of these aspects have a place in understanding how you should be managing your risk, if you apply this simple formula of leverage, you don't need to understand all of this. If you do understand some of these things, margin and percentage of your account and the amount of margin that the broker offers you, that's cool. Then you can basically just understand it. It doesn't really actually help you to do anything in your trading, but what you need to know is leverage. If you can understand that, then none of this stuff is important to understand. You don't need to learn any of it whatsoever. You can completely ignore it, and you might think, well, this guy's nuts. What on earth is he talking about? Of course I need to understand those things. Well, take it from me, you don't. Leverage is the only thing you need to understand, and that's what I'm going to talk about right this minute. So let's get to it. So I found a really handy tool to switch this pen on and off. So let's talk about leverage. And this really goes hand in hand with risk percentage. So once again, if you understand leverage, then risk percentage will follow automatically. And that's why I want you to get to grips with this, because risk percentage is really important. Now, leverage is the amount of money that's in your account multiplied by however much you are willing to risk. So basically what the broker says, let's start with $1,000. If you have $1,000 in your account, that's how much money you've deposited. Simple as that. No, don't worry about anything else apart from this very simple explanation. If you've got $1,000 in your account, the broker, and this is where they're very, very naughty and sneaky and quite dishonest, really, in a sense. The broker will often offer you 100-to-1 leverage. And sometimes they call this margin, whatever it might mean. The broker will offer you that. In other words, what he's saying to you is you can multiply your account balance times 100, and you can place that trade lot size. So you've got $1,000 in your account. The broker's saying to you, hey man, you can trade 100 times that amount. All right? So you can trade $100,000 in your account, and all you have to do is to make sure that you've got $1,000 in your account to cover the margin. It's like a little deposit. They're saying you put $1,000 in, we'll let you trade $100,000. Now, this is extremely dangerous. I want you to completely ignore it. Doesn't matter what the broker says to you. It's a whole load of bollocks. And there is a stronger word I could use, but I'm not going to, because there might be children listening to this video, or some people might take offense. So the broker's saying you can trade $100,000. All you need to do is put $1,000 in your account. That's what's called 100-to-1 leverage. Now, some brokers will even offer 200-to-1 leverage. Any of these numbers is completely ludicrous. All you've got to do is to take one bad trade and your account's wiped out, or you've had a margin call. So some brokers will say, hey man, you've got $1,000 in your account, I'll let you trade $200,000.